Hi, good morning, everybody. William Shashaty here with Trinity Mortgage. Hope everybody's doing well. Over the weekend, I was talking to some friends, and we were talking about the difficulty in purchasing a home today and being able to save a down payment for the home. So we had the conversation about, saving 20% for a down payment. And nobody wants to put down less than 20% because they don't want to pay private mortgage insurance. So as you know, or as most people know, that if you put less than 20% down on a home, if you put 15% or 10% or 5% down, there's a private mortgage insurance, an additional payment you have to make, okay, basically to insure the lender against default because your down payment's so low. So now we have people who want to save 20% for a down payment. And I started to think, I said, look, when you think about it, the minute you're able to buy a home, even with 5% down, or even with 3% down, or even with 3.5% down, okay, you should do it. You should not wait however long it takes to save 20% down. And you're saying to me, are you telling me to pay private mortgage insurance? The answer is yes, I am. Here's why. On a $500,000 house, 20% is $100,000. How long will it take you, or for example, in this case, their children or their adult children who are saving for a home, how long will it take them to save $100,000? Now, if it was the same $500,000 house and you only put 5% down, that's $25,000 that you put as a down payment. Okay, makes sense. But how much is the private mortgage insurance for a $450,000 home, because it's a $500,000 purchase, $475,000 mortgage, right? Because you're only putting 5% down, right? So the private mortgage insurance is about $178 a month, okay, for only putting 5% down. Now remember, you're putting $25,000 down instead of $100,000, and you're paying an additional $178 a month to be able to do that. I just want you to think about something. Let's say it took you 2 years to save $100,000. Let's say it took you 3 years to save $100,000. $100,000 is a lot of money. Okay, in a year, that house that you would have bought is probably worth at least 5% more, $25,000 more. Okay, in 2 years, it's going to be worth $50,000 more. In 3 years, it's going to be worth $150,000 more, approximately. We know how much prices appreciate, right? So I'm being conservative at 5%. It's been a lot more lately, okay, but I'm being very conservative at 5%. So it doesn't make sense to avoid a $178 payment a month, okay, which is less than $2,400 a year, when you know you could have bought the home and it had at least $25,000 to $30,000 in appreciation. Okay, again, would you rather have $30,000 in equity, or would you or not pay the 2,500 or so, or excuse me, the 2,400 or so in private mortgage insurance? Of course, you would pay the 2,400 in exchange for $30,000 in equity, right? So I bring this up, and people always say to me, well, at $475,000 mortgage at a 5% interest rate today, okay, is $178 a month with a 700 credit score. By the way, if your credit score is 740, that mortgage insurance, instead of 178, goes down to 114 a month, right? So why wait to save $100,000 when you know that if all you have to do is pay 5% down, and you're going to pay an extra payment, and that extra payment can go away as the value goes up. But more importantly, what you're doing is you're not paying the $50,000 more for that house a year now or 2 years from now than you could have right now. Again, the smart thing to do, when you take all the factors in, is buy the house today with a minimum down payment, pay the private mortgage insurance. And oh, by the way, for those of you who are asking the question, well, what if the house doesn't go up in value? What happens if we go into this recession and nothing? Well, here's my answer. Okay, if you pay $178 a month in mortgage insurance, okay, and you have typical real estate taxes, okay, on your taxes every year alone, okay, you're going to save about $6,000. Think about that. So you're paying about $2,000 in private mortgage insurance, and even if your home doesn't go up in value, okay, you're going to be saving about $6,000 a month alone in taxes. Okay, it's not going to happen. It's going to go up in value. They always do. Okay, but would I rather save $6,000 in taxes and pay $2,000 a year in mortgage insurance just so I can buy a home now? The answer is yes. No reason to wait to avoid PMI. There's no reason to wait. Okay, 20% is very difficult today for a lot of people. Okay, especially with the prices of the homes. So I would not wait. I would pay the private mortgage insurance. We even have a way where we can do what's called lender paid mortgage insurance, where you don't see it in your payment. It's the interest rate's a little bit more, and the payment, by the way, is a little less than the typical borrower paid MI. But again, still, you have to make the wise decision, the good financial decision. Buy a home today. Put the minimum down, even if you have to pay mortgage insurance. Thanks so much for listening. Please follow us on Twitter and Instagram. Please like us on Facebook. Please like our YouTube videos. Click the bell and subscribe so you get the next one. Thanks so much for listening, and we'll see you next time.